Hi, welcome back to this my third data update for 2022. In this session, I'd like to focus on inflation and its implications for all things investment related. Now, during the course of 2021, we saw inflation come back at levels we haven't seen in decades. And for much of the year, it seemed to be either that we were all collectively in denial, and by we I include central banks, investors, companies, or casually dismissive of its consequences. Initially, the excuse was this was because we're recovering from COVID and this too shall pass. And when that stopped working, it was supply chains that became the target. By the end of 2021, it's clear that inflation is not transient, that it's not going to go away as quickly as some people thought it would. And during 2022, there's going to be a reckoning on inflation, though I'm not sure how serious it's going to be for investors. So to start the ball rolling, I'm going to go back and review some of the things I talked about in a session I did last year on inflation. I won't repeat myself, but I said measuring inflation is more tricky than it sounds because it depends on how you construct the basket of goods and services you measure, how you get the prices, you sample the prices. It could even depend on whether you're looking at it from the perspective of consumers. So you have a consumer price index, from producers, a producer price index, or you're looking at it as a deflator for the GDP. In fact, in this graph, I've looked at all three measures of inflation in the US. So the consumer price index, seasonally adjusted, not adjusted, the producer price index, and the GDP deflator, going back in time to 1950. And you can see that the three measures, in spite of all the talk about differences, pretty much send the same message. They move together, and in 2021, they all delivered the same message, which is inflation is higher than it's been historically. The CPI said it was around 7%, again, levels we haven't seen since the 1970s or 80s. The PPI jumped 20.21%. You could argue that some of that reflects the supply chains, and the GDP deflator was 5.9%. So every single inflation measure is in agreement. But these are all still measures of the past, and investing is about expected future inflation. Now, there are measures of expected future inflation. One comes from the markets. In fact, if you take the difference between the 10-year T-bond rate and the 10-year TIPS rate, they're both Treasury rates, they're both 10-year rates, but the TIPS rate is a real risk-free rate. That difference is a measure of expected inflation. The red line that you see on this graph is the expected inflation that comes out of the Treasury market. And based on those numbers at the start of 2022, the expected inflation going forward is 2.51%. Higher than it's been for a while, but not supernaturally high. Consumer expectations of inflation are measured from a survey that the University of Michigan does, and consumers clearly seem to be much more wary about inflation. In fact, by the end of 2021, they were forecasting expected inflation of about 5%. So already you can see a divide between what consumers are expecting and what investors are expecting. But lest you believe that bond market investors are the be-all and the end-all of the game, collectively it looks like investors are getting a little more worried about inflation. The Federal Reserve actually computes a measure of what percentage of investors expect inflation to be higher than 2.5%. It's in what's so magical about 2.5%. About a decade ago, the Federal Reserve put out a target, a loose target that it didn't want inflation to exceed 2%. So 2.5% is above that target. And at the start of 2022, that number, the percentage of investors expecting inflation to be greater than 2.5%, was 94%. 94%. And just to give you a sense of how much that number has changed, at the start of 2021, that number was around 7%. During the course of 2021, the percentage of investors expecting inflation to be greater than 2.5% has clearly skyrocketed. The Fed also keeps track of investors expecting deflation. That number was sticky for a long time. It was 5, 6, 7% through much of the last decade. At the start of 2022, the number was vanishingly small. Maybe Kathy Woods, who believes that deflation is coming back, and 5 or 6 other people in the market might believe it, but there are very few investors expecting deflation to come back. So let's sum up. Actual inflation is up, expected inflation is up, and investors, the larger and larger percent of investors expected inflation to come back. So here's where we are. It is a fact that inflation was back in 2021. I don't think that can be debated. It's a fact. The debate is about why it happened and how long term the consequences are going to be. I'll give you the benign view that this too shall pass, that once we start to get out of COVID and supply chains settle down, that inflation is going to revert back, maybe not to the 0.5%, 1% we saw in 2019, but perhaps to around 1.5 to 2%. So in the benign view, inflation is passing, it's going to go through, and we can, for the most part, kind of go back to the way things used to be. The more malignant view is that this is long term, that this is not just a consequence of COVID and supply chains, and it's a result of, big money spending packages that we can't afford. And those consequences are going to be more long term and potentially more dangerous. So to understand how inflation is going to play out, we turn to interest rates first. Again, during the course of 2021, if you look at what US Treasuries did, in this chart I have Treasuries across different maturities, 3-month, 2-year, 5-year, 10-year, 20-year, 30-year. Across the board, rates rose, except for the 3-month T-bill, which pretty much stayed around zero. 2-year, 5-year, 10-year, 20-year, 30-year. But there's an interesting story here. The 2-year, the 5-year, and the 10-year all rose much more than the 20 and the 30-year. In fact, if you're one of those believers in the yield curve, that you look at the difference in treasuries of different maturities, it's a very confusing year. The 10-year versus the 3-month, you saw the yield curve become much more upward sloping, but almost all of that happened between the 3-month and the 2-year, because the 10-year versus the 2-year, there was almost no difference in the slope of the curve. And in fact, if you compare the 30-year to the 10-year, the yield curve actually became flatter. Rates rose, the yield curve went all over the place. It steepened in the really early stages of maturity, but then flattened out. The question is, what next? Now, if you look at corporate bonds, they told a story too. In this graph, I have the default spreads on corporate bonds. What do they measure? They measure the price of risk in the corporate bond market. Let's start with the easy conclusions first. Obviously, lower rated bonds have bigger default spreads than higher rated bonds. But take a look at what those spreads did during the course of 2021. If you look at the highest ratings classes, they pretty much stayed flat. AAA, AA, single A, the default spreads were roughly what they were at the start of the year. But if you look at the lower ratings classes, there was a significant drop in default spreads. In fact, if you remember in the last session, I talked about implied equity risk premiums decreasing over the course of 2021. You see the same phenomenon play out in the lower rating classes in the corporate bond market. If there's a price of risk in the bond market, just like in the price of risk in the equity market, it went down during the course of 2021. A testimonial to how risk capital is not just staying in the game, but actually supplying more capital. Now, what's the link between inflation and interest rates? I know for the last decade it's become fashionable whenever we talk about interest rates to turn the discussion to the Fed. And I think it's incredibly unhealthy to make it all about the Fed. I've long believed that central banks don't set rates, they influence rates. So what sets rates? The drivers of interest rates in the long term can be seen when you decompose a nominal risk-free rate, like the T-bond rate, into two components, an expected inflation rate and an expected real interest rate. It's called the Fisher equation. It's actually a very, very good way to think about interest rates. If you make actual inflation a proxy for expected inflation and real GDP growth a proxy for the real interest rate, you can construct what I call an intrinsic risk-free rate. It's inflation plus real GDP growth. So in this graph, I've actually computed that number every year going back to 1954 and compared it to the actual T-bond rate. The red line is the actual T-bond rate. The blue column plus the gray column is the contemporaneous intrinsic risk-free rate. Now, the problem with using each year's inflation and real GDP growth is we know those numbers tend to move around. So if you use a smoothed out version where you take the average over 10 years, you come up with a black line. Think of this as your intrinsic risk-free rate. Do the two move together, the T-bond rate and the... Absolutely. And if you look at the last decade, there's an answer to a question that people have been asking for much of the last decade. How come interest rates are so low? Now, I know, again, people say it's a Fed and quantitative easing, and that played a role, don't get me wrong. But the real reason rates have been low for the last decade is a combination of low inflation and low real growth. And if you look at the start of 2022, there is an interesting divergence that's opening up between the intrinsic risk-free rate and the T-bond rate. The T-bond rate is clearly much lower than the intrinsic risk-free rate. And in my experience, when you see that divergence, it almost always closes. It can close in one of two ways. Either the T-bond rate can increase. In fact, in the first few weeks of 2022, you've seen that. Or the economy can go into a recession and real growth and inflation can come down. I'm not sure which is the preferable option. Both have consequences, but my guess, one of those two things has to happen. Now, if you think about inflation, we tend to think about inflation as a number, but I think it's actually much more useful to break inflation down into expected inflation and unexpected inflation. Sounds like I'm playing with the number, but let me explain why there's a big difference between expected inflation and unexpected inflation. As investors, as businesses, if you have expected inflation, you can incorporate it into your decisions. As bond investors, for instance, you can bring in that expected inflation into the interest rates you charge and cover the inflation. As businesses, you can try to charge higher prices because you know inflation is coming, you can build it into your costs. I tell people, look, if inflation is 10%, but it's guaranteed to be 10%, investors and businesses will learn to deal with it. It's unexpected inflation that blindsides us because we can't plan for it. We set an interest rate based on expected inflation. If actual inflation turns out to be higher than expected, we're blindsided. We end up losing returns. So I think it would be useful to break inflation down into expected and unexpected components. And here's how I'm going to do it. I'm going to cheat. I'm going to use the average inflation over the last 10 years as my proxy for expected inflation. Now, for the last 20 years, we've had more sophisticated proxies, as I showed you, the T-bond minus the TIPS rate. But since I'm going back all the way to the 1950s, this is the 1930s, 1928. The proxy that I am most able to do is to compute actual inflation rate minus the average over the previous 10 years. If you look at this chart and you look at the columns at the bottom, that is actually unexpected inflation. So when that's a negative number, inflation is coming in below expectations. When that's a positive number, inflation is coming in above expectations. If you look at the 1970s, you had a decade where inflation year after year came in above expectations. If you look at the 1980s, year after year, inflation is coming in below expectations. You might say, so what? No, it's tough to read in this graph. But in periods where inflation comes in above expectation, it turns out that stocks and bonds don't do very well. In periods where inflation comes in below expectations, they do much better. I know it's tough to read in this graph, so I decided to try a different ploy. I took the 94 years of data that I have, and I broke it out into 5 quintiles based upon the level of unexpected inflation. So the bottom quintile are the years where unexpected inflation was most negative, where actual inflation was much lower than expected. The top quintile is when inflation is much greater than expected. So the 1970s would be towards the top quintile. The 1980s would be towards the bottom quintile. I've looked at returns on stocks, T-bills, T-bonds, and corporate bonds in both nominal and real terms. The difference, of course, is the inflation difference. Let's take stocks. Clearly, stocks do much better in real terms when inflation comes in at expectations or below, and they do worse when inflation comes in above expectations. T-bills, T-bonds, and corporate bonds display the same phenomenon. In fact, it's far worse for bonds. And if you look at T-bonds and corporate bonds, the return becomes a significant negative number when inflation is greater than expected. If history is any guide, if inflation comes in above expectations, it's not good for financial assets. If it comes in below expectations, much better for financial assets. Now, if you break stocks down and you say, well, do some kinds of companies do better when inflation is higher? Well, there seems to be an answer in the data as well. In fact, I've taken 2 slices of stocks here, I've looked at stocks in 2 dimensions. The first is I've broken companies down into deciles based on market cap, from smallest market cap to largest market cap. And if you look at how they perform, again, based on what unexpected inflation is, when inflation is far lower than expected, the largest market cap stocks do much better than the smallest. It's when inflation exceeds expectation that the small cap premium shows up. Again, with the other dimension I looked at was lowest price to book versus highest price to book based on deciles. It's a very rough, I know, don't don't take this out on me. I know for your definition of value investing is probably much more nuanced, but for the longest time, this has become a rough proxy for value versus growth. And again, if you look at the differences across the quintiles, while the lowest price to book stocks beat the highest price to book across all the quintiles, they do much better when inflation is high. So maybe if you're an old-time value investor, or you've been an investor who's lost out on the small cap premium for the last 2 decades, one of the upsides of inflation coming back is maybe you will see a return of the small cap premium and a value premium. Those are financial assets, and none of them do well in the context of inflation. All you can do is do less badly with small cap stocks and low price to book stocks, and with large cap stocks or high price to book stocks. What about real assets? I've picked 2 where I have data going back in time, gold and real estate, and looked at nominal and real returns. And here you can see a difference from the financial asset classes. Both real estate and gold don't have the same falling off in returns that you saw with financial assets. In fact, if you look at real estate, it's pretty neutral as you look at and I would focus on the real returns, not the nominal. Nominal returns, real estate does much better when inflation is much higher than expected. But you look at the real returns, real estate holds its own. So it's a neutral hedge. Gold, though, goes beyond holding its own. It actually does much better when inflation is greater than expected. So while real estate is a neutral hedge, gold is a bet on inflation. If you think inflation is coming back, go with gold. You'll make a much higher return. But inflation turns out to be less than expected, don't be surprised if your returns turn out to be close to zero or even negative. Let me close off by now talking about currencies. You're saying, how does inflation play out? Well, much of what I've talked about so far, in fact, all of what I've talked about is about inflation in the US, which affects the US dollar. But inflation is currency specific. Let me put it this way. You can have a year where inflation is high in one currency and low in another. It is true that inflation in a currency like the dollar can spill over into other currencies because commodities are priced in dollars. But in general, inflation rates can vary across currencies. And when they do, they affect 2 things. And 2 things that we use constantly in finance. One is the level of interest rates, and the other is exchange rates. To see how inflation plays out in interest rates, here's what I try to do. Start of every year, and in fact once in the middle of the year, I compute risk-free rates in different currencies. Now, we've all been taught to use the government bond rate in a currency as the risk-free rate. The US, that's why we use the T-bond rate as our risk-free rate in US dollars. There is a problem, though, with government bond rates that we have to confront. Not all governments are default-free, and when you buy a government bond denominated even in the local currency, there's a chance of default risk. You might say, why? They can always print more currency. They can, but they don't always do it. In fact, half of all sovereign defaults in the last 50 years have been local currency defaults. It's a long-winded way. What I'm trying to say is just because you have a government bond rate in Nigerian naira or Turkish lira doesn't mean you have a risk-free rate. So here's what I did. I took the government bond rate in about 30 currencies. Those are all the currencies in which I was able to find a government bond in the local currency. I assumed those rates were set by markets. And then I subtracted out a default spread, a sovereign default spread based on the local currency, sovereign rating for that country. So if you look at the red portion of this graph, those are my default spreads. So if you look at the default spreads netted out, I get a risk-free rate in the blue. So let me start with making an obvious statement. Risk-free rates obviously vary across currencies. Much higher in the kwacha and the Turkish lira than in the Chilean peso, much higher in the peso than in the US dollar, much higher in the dollar than in the Swiss franc. I know I'm being simplistic, but the primary reason for differences in risk-free rates across currencies, remember I've cleaned up for default risk, is differences in inflation. In fact, once you see that, you can actually come up with a different way of getting risk-free rates in different currencies. And I strongly recommend this for people who don't trust the government bond rate in the local currency. For instance, you might say, look, I don't trust the Pakistani government bond rate in Pakistani rupees because it doesn't give me a true measure of the risk of the government rate, even in the local currency. Here's my suggestion. Or if you cannot find a government bond in your local currency, you can build up to a risk-free rate in your currency by doing the following. Start with a currency where you feel you can estimate the risk-free rate. I'll take the US dollar and use the T-bond rate as my risk-free rate. Then estimate expected inflation in the US dollar and in the local currency. In the US dollar, it's easy to get the expected inflation. You can use the T-bond minus TIPS rate if you want. But in the local currency, you have to often struggle. I mean, you might have to use last year's inflation, or the IMF actually makes estimates for the future. I don't know how good they are in some of these countries, but you can take that differential inflation. Here's the shortcut. If your US risk-free rate is 1.5%, but inflation in Indonesia is 4%, and the US inflation is only 1%, in fact, inflation is 3% higher, you can add the extra 3% to the US dollar risk-free rate and then get an Indonesian rupiah risk-free rate. The full calculation is a little messier. It'll give you an answer very close for most currencies, but it requires a compounding effect. The bottom line is you can get to a risk-free rate in any currency if you have expected inflation. In fact, the same phenomenon of differential inflation is also what drives exchange rates. If you think about the relationship between forward and spot exchange rates in a currency, there's one of the oldest theorems I won't even call it a theorem, one of the oldest propositions driving exchange rates is purchasing power parity. Put simply, if you're looking at two currencies, one is a 10% inflation rate, the other is a 1% inflation rate, the higher inflation currency should depreciate about 9% a year on an expected basis. So the extent that you have differences in expected inflation across currencies, you should see it play out in the higher inflation currency depreciating over time. Again, the pushback is you're being simplistic. You're absolutely right. There are other factors that can cause short-term movements in exchange rates, but in the long term, it is very difficult to overcome that inflation differential. Now, one final point here, which is, if you have a point of view about inflation in different currencies, it's going to play a role in how you invest for the next year, the next few years. If you believe that the story we told about the US of inflation coming back and staying high is a story you can tell all over the world. In other words, inflation rates are going to rise across the world. The effect on exchange rates is going to be muted because every currency's exchange rate, inflation rate is going to go up. But if you believe that some countries are going to see high inflation and others are going to see low inflation, then it has consequences if you're investing. So, for instance, if you're an investor who's investing in US dollars and you are looking at countries where you think inflation is going to increase over time, then on a predicted basis, their currencies will weaken over time, and investments you make in those countries, then local currency returns are going to end up getting discounted in your hands. So whether you invest overseas or not, or where you invest, it's not whether, where you invest overseas can be driven not just by your view about inflation in the US, but also your views about inflation in other countries. So inflation affects interest rates, inflation affects asset returns, both real and financial. Inflation drives currencies and exchange rates. So as with any historical data, I'll add the standard disclaimer, and you've read it often enough that it's become almost ignorable, which is past results are no predictor of future results. I'm not trying to talk you into or out of doing something, but I think your point of view about inflation is going to drive how you approach investing this year, and that's stating the obvious. If you believe that last year's surge in inflation is temporary, that things are going to go back very quickly to a low inflation environment, then I think you will probably end up staying with what you're doing right now, investing in high-tech stuff. What worked last year, the last decade, will continue to work, which is you're going to stay invested in stocks, and you will still focus on tech companies and highly priced stocks and high-growth companies, perhaps large-cap companies, which will continue to do just like they did the last year. If, on the other hand, you think inflation is here to stay, that we're being a little too cavalier and that the bond market is going to come to its senses, I think you need to change the way you invest. You probably have to shift away from financial assets to real assets. Easier said than done. And you probably have to start shifting from large cap to small cap, from high growth to more mature companies. You may wonder why I've not talked about cryptos and NFTs in the space, and I wish I had the historical data with cryptos and NFTs to have brought them into the discussion. But let me say, close in by pointing out that if you're investing in cryptos or NFTs, you are either investing in them in a crypto as a currency or as a collectible. So let's take Bitcoin as your typical crypto. If you believe that Bitcoin is a good currency and you can make an argument that its exchange rate will improve over time, then investing, putting your money in Bitcoin will yield good results. But if you don't think it's a great currency, then obviously not. But I think the argument here with cryptos and NFTs is that they will operate like gold, a millennial collectible. And I don't have enough historical data to either prove you right or wrong, but the slice of data that we have, which is 7 or 8 years of data, doesn't look good for cryptos as collectibles. And here's why. If cryptos were collectibles, they should hold their value when stocks are doing badly. And if you look at how cryptos behaved in 2020, kind of test of how well they would behave as collectibles. During 2020, Bitcoin and other cryptos behave more like very risky stocks than they did like gold. Now, of course, that could change. It's still early in the game. But inflation, I think, is going to be the story for 2022. How it plays out and what you think about its future course is going to have a huge role in how and where you invest. I wish you the very best, and thank you very much for listening.